Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us discuss today investment decision. A successful finance mainly depends on the proper decision making in respect of the investment of funds. The investment of funds, how and where available funds will be invested, you are understanding with the help of the capital budgeting. So capital budgeting is a technique of decision making, and it's a firm's investment on current funds most effectively for long-term activities for anticipating an expected flow of future benefits is called as capital budgeting. And capital budgeting is a long-term planning for making the finance proposed capital outlay. With the help of this, we'll understand the process of capital budgeting. Before that, it just will understand what is capital budgeting. It's a process of acquisition and investment of capital. The process of capital budgeting are identification of potential investment opportunities, assembling of proposed investment, decision making, preparation of capital budget and appropriations, implementation, performance review. The first process is identification of potential investment opportunities. So you are identifying what opportunities are available for the investments, and by understanding the external environment and for formulating the well-defined corporate strategies through using the analysis of SWOT, and you are using a corporate strategies perspective persons who all are involved in the capital budgeting process, and you are motivating employees to make suggestions to involve in the decision making activity, capital budgeting decision. Once you identify the investment opportunities, then you are assembling of investment process or proposal. That is, you are taking the requirement from the other department also for the investment proposals, because other departments may have replacement investment, expansion investment, new product investment, or obligatory and welfare investments. Then once you assemble, then you are making a decision related to the investment, then preparation of capital budgeting and appropriations, your smaller outlay which can be decided for the executing the lower levels. Prepare your lower level, you are applying, then you are converting into, you are expanding the actions. Then implementation is the translating of investment proposal into project in the by understanding the risk factor, and you need to formulate with the projects which you have decided, and you need to follow the responsibilities of accounting and network techniques. Then performance review is nothing but a feedback for the project which you have implemented through how realistic your assumptions are, because you have made an assumption, a planning, it's a future forecasting, right? So that is why you are understanding how realistic your assumptions were, and it provides documentation for the future experience and further decision makings, and it helps in the uncovering the judgmental biases and cautions among the project sponsors. Then project classification. Project classifications are entitled for time and efforts, and it is justified by the benefits from the, and here we have project classification: mandatory investment, replacement project, expansion project, diversification project. In these four circumstances your investments takes place. First one is mandatory investment. It is required expenditures for a statutory requirement. Then replacement is routinely equipment you are using, you need to replace it for inefficiency, then you want to work it for serviceable conditions, that is replacement project. Expansion of the project, increasing the capacity and widening the distribution network, for that. Diversification of project, investments in producing new product or services for entering into entirely new geography, it is a diversification of project. Or research and development is also one of the classification, for very small proportion of capital budgeting in all the Indian companies, and miscellaneous of the project that includes interior decoration, recreational like facilities, execution, aircraft, landscape, gardens, and these are the some of the example for the miscellaneous of the project. The next one is we have different phases of capital budgeting. The phases of capital budgeting is project generation, project evaluation, project selection, project execution, follow up, and feedback. Project generation is this is the first basic step for the capital budgeting. It involves you are generating ideas on your investment. Project evaluation, you are evaluating the projects for understanding the feasibility of analysis, and you are estimating the cost, benefit, and the benefits. Then project selection. Among the available alternatives, you are selecting the best available alternative options. Then project execution. Once you have selected, after selection, the proposal will be executed or implemented, conversioning idea into an action. Then follow up or feedback. Once you have implemented the process, you will need to take an feedback, and for the follow up should be done. Check whether planned things are implemented or executed effectively. For that, follow up and feedback will be taken. Then methods of capital budgeting. There are two methods in capital budgeting: traditional method, modern method. It is also called as non-discounting method and discounting method. Under traditional method, we have payback period method, accounting rate of return method. Under modern method, that is discounting method, we have NPV, that is net present value method, internal rate of return, profitability index, modified internal rate of return, EVA, APV method, utility method. First, we will understand payback period method. So, this method talks about how many years, within and how many years your return will be recovered. So, that is payback period. Time required for recovering your initial investment in the project from the operations is called as payback period method. Accept and rejection criteria. When single project is there, the payback period within the period specified will be accepted, if more than that, rejected. In case of mutually exclusive projects, shorter payback period will be accepted, longer will be rejected. Advantages of this payback method is it is very easy to understand, and capital projects return large, easily cash flows will be calculated, and it addresses ratioing issues easily, and it remains major supplementary tool for the investment analysis. And there are disadvantages also under this method, that is it ignores the any benefits that occurs after the payback period, and it does not measures the total income, only recovered amount. Once amount is recovered, more than higher is that also it is ignored. Then time value of money is ignored under this method. It's difficult for distinguishing between the project different sizes, and initial amount are vastly divergent, and it overemphasizes on short-term profitability. The formula to calculate payback period is when annual cash flows are uniform, payback period is equal to original investment divided by annual cash inflow. When annual cash inflows are not equal, then number of years before recovery of original investment plus amount to be recovered cover original investment divided by total cash flow during the year of payback. Here we have question. See, a project needs a total investment of 4 lakh. The project promises a total cash inflow of rupees 20,000 for 30 years. Compute the payback period. For this, you need to compute. Here, what is his initial investment or original investment is 4 lakh. 4 ಲಕ್ಷ ಇನ್ವೆಸ್ಟ್ ಮಾಡಿದ್ದಾರೆ ಒರಿಜಿನಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. ಎಷ್ಟು ವರ್ಷಗಳಲ್ಲಿ ರಿಕವರ್ ಆಗುತ್ತೆ? ಅವ್ರಿಗೆ ಕ್ಯಾಶ್ ಇನ್ಫ್ಲೋ 20,000 ಇದ್ರೆ, ಸೊ ಅವಾಗ ಒರಿಜಿನಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಡಿವೈಡೆಡ್ ಬೈ ಆನ್ಯುವಲ್ ಕ್ಯಾಶ್ ಇನ್ಫ್ಲೋ. ಒರಿಜಿನಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಎಷ್ಟು? 4 ಲಕ್ಷ ಡಿವೈಡೆಡ್ ಬೈ 20,000, 20,000 ಡಿವೈಡ್ ಮಾಡಿದ್ರೆ 20 ಇಯರ್ಸ್ ಬೇಕಾಗುತ್ತೆ ಅವ್ರಿಗೆ 4 ಲಕ್ಷ ರಿಕವರ್ ಆಗಕ್ಕೆ. ದಟ್ ಈಸ್ ವಾಟ್ ಈಸ್ ಕಾಲ್ಡ್ ಆಸ್ ಪೇ ಬ್ಯಾಕ್ ಪೀರಿಯಡ್. ಅಮೌಂಟ್ ರಿಕವರ್ಡ್ ಇನ್ ಹೌ ಮೆನಿ ಇಯರ್ಸ್? ದ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್. Okay, here we have one more question. A project requires an initial investment of rupees 1,20,000 and yields an annual cash inflow of rupees 40,000 for 7 years. What is the payback period? Original investment divided by annual cash inflow. 1,20,000 divided by 40,000. How many years? Within 3 years you are recovering 1,20,000. Here we have question. The project cost 5 lakh and yields annual profit of 80,000. After depreciation at 12% per annum but before tax of 50%. Calculate payback period. So here profit is given. The profit after depreciation before tax is given. Tax we need to deduct. After deducting tax only, we are calculating the annual profit after tax and before depreciation. Depreciation we are adding back and tax we are deducting here to calculate the payback period. Okay, annual profit after depreciation is 80,000. Income tax is given 50%, 40,000. 80 minus 40, 40. Depreciation is at 12%. On 5 lakh, 12% is 60,000. 60 plus 40, 1 lakh. Annual profit after tax before depreciation is 1 lakh. Now let us calculate the payback period. Payback period is original investment is how much? 5 lakh divided by and 1 lakh is the cash flow. 5 lakh divided by 1 lakh is 5 years. In 5 years you are recovering the initial investment, original investment. Remember, for payback period you are taking, while calculating payback period you are adding back depreciation. That you need to remember. Now, from the information given below, calculate payback period. Original cost of investment is 5 lakh. Annual cash inflow after tax 60,000. Annual depreciation 40,000. So, depreciation is given. Annual cash inflow is 60. Annual depreciation is 40. 60 plus 40 is 1 lakh. Original investment is 5 lakh divided by 1 lakh, 5 years. Let us understand with this question, when we have different cash flows, how to calculate the payback period. Cost of plant is 2 lakh and cash flows for the first 3 years are 20,000, 80,000 and 1 lakh 20,000. Express the payback period in terms of years. So how many years? 3 years. 3 years is given. Cash flow is 20, 80, 1 lakh 20. Here you need to calculate cumulative cash flow to find out the payback period. Payback period na calculate ಮಾಡ್ಕೊಳ್ಳೋಕೆ ನಾವು cumulative cash flow ನ find out ಮಾಡ್ಕೋಬೇಕು. Cumulative cash flow ಅಂದ್ರೆ ಗೊತ್ತಲ್ವಾ, add ಮಾಡ್ಕೊಳ್ಳೋದು. 20,000, 20 plus 80, 1 lakh, 1 lakh plus 1 lakh 20, 2 lakh 20. Now, what is your initial investment? 2 lakh. ನೋಡ್ಕೊಳ್ಳಿ, 2 lakh ಇಲ್ಲಿ ಸೆಕೆಂಡ್ ಇಯರ್ ಅಲ್ಲಿ 1 ಲಕ್ಷವರೆಗೂ ರಿಕವರ್ ಆಗಿದೆ. ನಮಗೆ ಇನ್ ಬರ್ಬೇಕಾಗಿರೋದು ಎಷ್ಟು? 1 ಲಕ್ಷ. ಆದ್ರೆ ಇಲ್ಲಿ ಎಷ್ಟಿದೆ? 2,20,000 ಇದೆ. ನಮಗೆ 2 lakh 20 ಬೇಡ. ಅದನ್ನೇ ಈ ಮೆಥಡ್ ಡಿಸ್ಅಡ್ವಾಂಟೇಜ್ ಹೇಳಿದ್ದು. ಇಟ್ ಇಗ್ನೋರ್ಸ್ ದಿ ಆಫ್ಟರ್ ಕ್ಯಾಶ್ ಫ್ಲೋಸ್ ಅಲ್ವಾ. ಸೊ 1 lakh ಮಾತ್ರ ಬೇಕು. ಈ 1 lakh ನ ಎಷ್ಟು ಮಂತ್ಸ್ ಅಥವಾ ಇಯರ್ಸ್ ಅಲ್ಲಿ ರಿಕವರ್ ಮಾಡ್ಕೋತೀರಿ? ಫಸ್ಟ್ 2 years ಅಲ್ಲಿ 1 lakh ಬಂದಿದೆ. ನೆಕ್ಸ್ಟ್ ಟೋಟಲ್ ನಮ್ಮ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಎಷ್ಟು? 2 lakh. ನಮಗೆ ಬರ್ಬೇಕಾಗಿರೋದು ಎಷ್ಟು? 1 lakh. 2 lakh minus 1 lakh is 1 lakh. 1 lakh divided by 1 lakh 20,000 means 0.83. 2 years, 2.83 years you need. Your payback period is 2.83 years. Okay, understood. Now a industry is considering investment in a project which cost 6 lakh. The cash flows are 1 lakh 20, 1 lakh 40, 1 lakh 80, 2 lakh and 2 lakh 50. Calculate payback period. Now let us calculate payback period. Cash year, totally 5 years. Cash flow 1 lakh 20, 1 lakh 40, 1 lakh 80, 2 lakh, 2 lakh 50,000. Cumulative cash flow is, first year you are writing as it is 1 lakh 20, 1 lakh 20 plus 1 lakh 40, 2 lakh 60, 2 lakh 60 plus 1 lakh 80, 4 lakh 40, 4 lakh 40 plus 2 lakh, 6 lakh 40, 6 lakh 40 plus 2 lakh 50, 8 lakh 90,000. Now, what is your initial investment? Is 6 lakh, right? 6 lakh. ನೋಡಿ, ಇಲ್ಲಿ 4 lakh 40 ನಮಗೆ 3 years ಅಲ್ಲಿ ಬಂದಿದೆ. ಸೊ 3 years. ಯಾಕಂದ್ರೆ 4th year ಅಲ್ಲಿ 6 lakh 40 ಇದೆ. ನಮ್ಗೆ 6 lakh 40 ಬೇಡ, ನಮಗೆ ರಿಮೈನಿಂಗ್ ಬ್ಯಾಲೆನ್ಸ್ ಮಾತ್ರ ಬೇಕು. ನಮ್ಮ ಇನಿಷಿಯಲ್ ಇನ್ವೆಸ್ಟ್ಮೆಂಟ್ ಏನಿದೆ ಅದೆಷ್ಟು ಮಂತ್ ಅಲ್ಲಿ ರಿಕವರ್ ಆಗುತ್ತೆ ಅನ್ನೋದು. ಸೊ ಅವಾಗ 6 lakh is the initial investment and recovered amount is 4,40,000. Remaining balance 1,60,000. 1,60,000 divided by 2 lakh. In which year you are going to recover? The year amount ತಗೋಬೇಕು. Cash flow divided by 2 lakh. 1,60,000 divided by 2 lakh is 0.8. So 3.8 years is the payback period. Next question is, Neeraj Books Limited is considering the purchase of new machine. There are two alternative methods, X and Y. Of the machine, prepare a statement of profitability showing payback period from the following information. Here cost of the machine is given. X is 1,80,000, Y is 3 lakh. Estimated life is 10 years, 15 years. Estimated savings in scrap per year 12,000, 18,000. Additional cost supervision 14,400, 19,200 per year. Additional cost of maintenance per year is 8,400, 13,200. Cost of indirect materials per year is 7,200, 9,600. And estimated savings in wages, workers not required 150, 200. Wages per worker per year is 720, 720. Now assume tax at 50% of profit. Which model would you recommend? Now let us calculate this. What is the estimated savings in scrap? That is, estimated savings in scrap is 12,000, 18,000. Estimated savings in wages is, here number of workers not required, 150 workers are not required, and per worker 720. 720 into 150 is 1,08,000. 720 into 200 is 1,44,000. Total savings. First we are finding the total savings to find out the profit. Total savings is 1,20,000 for X, 1,62,000 for Y. Understood? No? Estimated savings in scrap is 12,000, 80,000 directly given. Estimated saving in wages is workers not required is given, means they are not working, ಅವರು ಏನು ವರ್ಕ್ ಕೆಲಸ ಮಾಡ್ತಾ ಇಲ್ಲ. 150 ಅವ್ರದ್ದು ಸೇವಿಂಗ್ಸ್ 150 ವರ್ಕರ್ಸ್ ಸೇವ್ ಆಗಿದೆ. ಪರ್ ವರ್ಕರ್ಗೆ 720 ಇದೆ. ಆಮೇಲೆ 200 ವರ್ಕರ್ಸ್ 720 ಇದೆ. 150 workers into 720 is 1,08,000. 200 into 720 is 1,44,000. Now total savings is 1,20,000 and 1,62,000. Now estimated additional cost for the additional materials is 7,200, 9,600 given. Cost of indirect material per year. The expenses, cost of supervision, all the expenses we are taking. First we found income, savings ಕಂಡಿಡ್ಕೊಂಡ್ರಿ. ಈಗ ಎಕ್ಸ್ಪೆನ್ಸಸ್ ನ ಕಂಡಿಡ್ಕೋಬೇಕು, ಫೈಂಡ್ ಔಟ್ ಮಾಡ್ಕೋಬೇಕು. 7,200, 9,600. ಕಾಸ್ಟ್ ಆಫ್ ಸೂಪರ್ವಿಷನ್ 14,400, 19,200. Additional cost of maintenance is 8,400, 13,200. So total expenses, total additional cost is 30,000, 42,000. So annual cash inflow is A minus B. 1,20,000 minus 30,000 is 90. 1,62,000 minus 42 is 1,20,000. Now less depreciation, because to deduct tax you have to deduct first depreciation, then only you are minusing tax. That is why you have to deduct depreciation first, again you have to add back to find out the payback period. Payback period ಕಂಡಿಡಿಯಕ್ಕೆ depreciation ನ add back ಮಾಡಬೇಕು. Okay, first minus ಮಾಡ್ಕೋಬೇಕು. Depreciation is given 1,80,000, 10 years life of the asset. So 1,80,000 divided by 10 is 18,000. 3 lakh divided by 15 is 20,000. Depreciation 18, 20. Profit after depreciation is 72,000 and 1 lakh. Less tax is 50%, 36,000, 50,000. Minus profit after tax and depreciation is 36,000, 50,000. We are adding back depreciation 18,000, 20,000. Now profit after tax before depreciation is 54,000, 70,000. Now the payback period is 1,80,000 is initial investment, 54,000 is the cash inflow, 3.5 years, and here 4.28 years. We'll solve one more question. Evershine Company Limited is considering the purchase of a machinery. Two machineries S and T, each costing 5 lakh are available. Cash inflows are expected to be as under. Calculate payback period. Year 2001, 2, 3, 4, 5. Machine S 1 lakh 50, 2 lakh, 2 lakh 50, 1 lakh 50,000, 1 lakh. Machine T is 50,000, 1 lakh 50,000, 2 lakh, 3 lakh, 2 lakh. Solve this question. This question is for homework. Now let us understand the next method under the capital budgeting, that is accounting rate of return method. So this is a financial metric. It is used for the to find out the profitability of the investment, and by comparing the average annual accounting profit which are generated in the investment to its initial cost. Average rate of return is equals to average annual profit divided by net investment in the profit, so project, into 100. Average annual profit, total profit after depreciation and tax. Understand this, it is very important. Under ARR method, we are taking after depreciation and tax. But under payback period method, we will take after tax, before depreciation, divided by number of years. Return per unit of investment method is return per unit. In per unit, if it is given, total profit after depreciation and tax divided by net investment in the project into 100. This is the formula for the ARR method. Still it is there. Return on average investment method. Return on average investment is equal to total profit after depreciation tax divided by average investment into 100. And calculation of average investment, when scrap value and additional capital is given, average investment is equal to original investment divided by 2. When scrap value is considered but no additional capital, then original investment minus scrap value divided by 2. If scrap value and additional capital is covered, then average investment is equal to initial investment minus scrap value divided by 2 plus working capital plus scrap value. Let us solve the question. Before that, we'll understand what are the advantages and disadvantages of this ARR method. And this is a simple and easy method for understanding. It provides better comparison on the projects with compared to the payback period method, and it is readily calculated by using the accounting data formulas we are using and we are finding. Disadvantages are this method also ignores the time value of money, and it's not suitable for the investment decision, and it ignores yearly rate of return of the project, and it does not consider any length of life of the project, and it ignores reinvestment concept. Those are the disadvantages of ARR method. Now let us solve the question. Initial investment rupees 12 lakh, scrap value is 2 lakh, working life is 5 years, additional working capital 1 lakh, calculate average investment. So in this question, initial investment is given, scrap value is given, and working capital, that is additional investment, is also given. So average investment is equals to initial investment minus scrap value divided by 2 plus working capital plus scrap value. This formula we are using. Okay. Initial investment is 12 lakh. Scrap value is minus 2 lakh divided by 2 plus 1 lakh working capital plus 2 lakh scrap value. 12 minus 2 divided by 2 is 5 lakh. That is 10 lakh divided by 2, 5 lakh plus 1 lakh plus 2 lakh. Total 8 lakh. 8 lakh is the average investment. Then initial investment is rupees 3 lakh. Scrap value is 50,000. Working life is 5 years. Additional working capital is 25,000. Calculate average investment. Average investment is equal to initial investment minus scrap value divided by 2, same formula we are using, because working capital and scrap value is given. When working capital and scrap value is given, we are using this formula. 3 lakh minus 50,000 is scrap value divided by 2 plus 25,000 is working capital plus 15,000. Now 3 lakh minus 50,000 is 2 lakh 50 divided by 2 is 1 lakh 25,000. Then add 25,000, 50,000. Total is 2 lakh. Determine the ARR from the following information of two machines A and B. Original cost is 56,125. Additional working capital 5,000, 6,000. Life 5 years. Both. Salvage value is 3 lakh. So 3,000 and 2,000. Tax rate is 55% each. Both A and B. Income after tax and depreciation. After tax and depreciation, income is given for 5 years. 1, 2, 3, 4, 5. 5 years it is given. Depreciation has been charged on straight line basis. Details is given. Let us find out the solution for the question. Now, statement of profit after tax. After tax is given. So, machine A and machine B. One, for 5 years, 3,375, 5,375, 7,375, 9,375, 11,375. Total 25 plus 5,375, 7,375, 9,375, 1,375. 36,875, and machine B is 11,375, 8,425, 7,635, 6,455, 5,355 is 39,245. Now, average annual profit. Annual profit divided by number of years. First, we are finding for A. Annual profit is 36,875 divided by 5. 36,875 divided by 5. Because 5 years is given, 7,375. Machine B is 5 years, same. 39,245 divided by 5 years. 7,840. 849. Now, average investment is initial investment minus scrap value, because scrap value is given in the question. So, we are using this formula, divided by 2 plus working capital plus scrap value or salvage value. 56,125 is the initial investment for A, minus 3,000 divided by 2 plus 5,000 plus 3,000. 56,125 minus 3,000 divided by 2 is 26,562.5 plus 5 plus 3, 8 plus 8,000. ARR is 34,562.5. You have to calculate for machine B. Same thing you need to do for machine B. Okay. Yes. Next question. A proposal requires an investment of rupees 10 lakh and has scrap value of 40,000. After 5 years, it is expected to yield profit after depreciation and after tax during the 5 years amounting to rupees 80,000, 1 lakh 20,000, 1 lakh 40,000, 1 lakh and 40,000. Calculate average rate of return on the investment, return per unit of investment method, return on average investment method, average return on average investment method. So here profit is given for the 5 years. So we need to find out average profit first. So what is the total profit? Total profit is 80,000, 1 lakh 20,000, 1 lakh 40,000, 1 lakh 40,000. 4 lakh 80,000 is the total profit. Now average annual profit is total profit after depreciation and tax, it is given It is divided by number of years, totally 5 years profit divided by 5. 96,000 is the average profit. Average annual profit is 96,000. Then net investment. Net investment is original investment minus scrap value. Only scrap value is given. Working capital is not given. That is additional capital is not given. So there is no require of adding. Only we are minusing from the original investment. That is about 10 lakh minus 40,000. 9 lakh 60,000 is the net investment. Average investment is 10 lakh minus 40,000. That is 9,60,000 divided by 2 average. We are doing 2. 4,80,000 is the average investment. Now average rate of return method formula is average annual profit divided by net investment in the project into 100. Now what is your average annual profit? Average annual profit we have found, that is this one, average annual profit. Average investment is different, average annual profit is different. For average investment we are dividing by 2, but average annual profit, for which number of years given, the profit which we have added, that will be considered. That is why you should understand this. Don't make mistake on difference. There is a difference between average annual profit and average investment. So this is average annual profit, 96,000. 96,000 divided by 9,60,000 is the net investment, right? Net investment is, that is original investment minus scrap value, 9,60,000. 9,60,000 into 100, 10%. So average rate of return method, average rate of return is 10%. Then return per unit of investment method, so formula is total profit after depreciation and after tax divided by net investment in the project into 100. Total profit, we have added all the 5 years profit, no? That is total profit after depreciation tax is 4,80,000, and what net investment in the project is 9,60,000 into 100, 50%. Then return on average investment method. Return on average investment is equal to total profit after depreciation and tax, after tax, divided by average investment into 100. This is total profit after depreciation and after taxes 4,80,000 divided by 4,80,000, average investment 9,60,000 divided by 2. 4,80,000 into 100 is 100%. And average return on average investment method is average annual profit after depreciation and after tax divided by average investment into 100. Average annual profit is 96,000 divided by average investment is 4,80,000 into 100. 96,000 divided by 4,80,000 into 100 is 20%. Saha Limited has under consideration the following 2 projects, details of which are as under. Project X, project Y is given. Investment of in machinery 10 lakh, 15 lakh. Working capital 5 lakh, 5 lakh. Life of machinery 4 years, 6 years. Scrap value of machinery 10%, 10%. Tax rate is 50%. Income before depreciation and tax. Before depreciation is given. Now for the year 6 years, for A it is 4 years given, for B it is given, project Y it is given for the 6 years. You are required to calculate the ARR and suggest which project is to be preferred. Now first we will find out the profit after tax and depreciation, because before depreciation tax is given. Now your original investment minus scrap value, that is 9 lakh for the project X. 10 lakh minus 1 lakh scrap value, 10% is given. So on 10 lakh, 10% is 1 lakh. 10 lakh minus 1 lakh, 9 lakh. Project Y is 15 lakh into 10% is 1,50,000. Minus is 13 lakh 50,000 is the project X, and project Y after my net investments. Here project X year is for 4 years 8 lakh, same amount is given. For project Y, first year 15, second year 9 lakh, third year 15 lakh, fourth year 8 lakh, fifth year 6 lakh, sixth year 3 lakh is given. Profit before depreciation and tax total 8 lakh into 4, that is 32 lakh, and their total is 15 lakh plus 9 lakh, 15 lakh, 8 lakh, 6 lakh, 3 lakh, 56 lakh is given. Less depreciation. Depreciation is given. The investment will be considered as depreciation 9 lakh and 13 lakh 50. After profit after depreciation and before taxes 23 lakh 42 lakh 50,000. Tax is 50%. On 23 lakh 50% is 11 lakh 50,000. On 42 lakh 50,000 50% is 21 lakh 25,000. Finally, you will get profit after tax and depreciation is 11 lakh 50 for project X, 21 lakh 25,000 for project Y. Now let us calculate average annual profit. Annual profit divided by number of years is, for first one 11 lakh 50 divided by 4 years is given. So annual profit we are finding, average annual profit 2 lakh 87,500. For project Y it is 21 lakh 25,000 divided by 6 is 3,54,167. Now average investment is initial investment minus scrap value divided by 2 plus working capital plus salvage value. Initial investment is 10 lakh minus scrap value is 1 lakh. 5 lakh is working capital, 1 lakh is scrap value divided by 2. Now 1 lakh, 10 lakh minus 1 lakh is 9 lakh divided by 2 is 4 lakh 50,000 plus 5 plus 1 6 lakh, 10 lakh 50,000 is the average investment for project X. Project Y is 15 lakh plus minus 1 lakh 50 plus 6 lakh divided by 2. We have to do 15. First divide, then add. 1 lakh 50 divided by 2 is 6 lakh 75,000 plus 6 lakh is 12 lakh 75,000. First take 15 lakh minus 1 lakh 50 divided by 2 is 6 lakh 75. 5 lakh plus 1 lakh 50,000, 6 lakh 50,000. 6 lakh 50,000, 13 lakh 25,000 is for the project Y. And ARR is average annual profit divided by average investment. Average annual profit is 2,87,500, which we have calculated already here. 2,87,500 divided by 10 lakh 50. Project X average investment into 100. ARR is 27.38. And for project Y 3,54,167. Already we have calculated, that is annual profit 3,54,167 divided by 13,25,000 into 100 is 26.75%. Here project X should be selected because ARR is compared to Y higher. That is why project X will be selected. Thank you for watching. Have a great day. Hope you all understood.